reckoning then should we expect?
Well, one of the things that we have to remember is that markets are so captive to consensus views. Remember where consensus was last year. We were worrying about whether it was 3 or 5, 25 basis points moves. We were worried whether inflation would be able to sustain itself above 2% so that the Fed can average its target, because disinflation was such a long history with us. So consensus has gotten things really wrong. And right now, the market is sort of looking at the new consensus trade, which is a slow recession or moderate growth and very little unemployment. And in the second half of the year, we start to revive and the Fed will start to pivot. That is, again, probably going to be as wrong as the first consensus was last year. And one of the things that we haven't worried about was, would inflation actually come down faster than people think? Because after all, the basis of the Fed's worry about inflation is the strong labor market. And everyone is talking about how strong job growth has been, how many job vacancies there are. But if you look at the household survey of employment growth has stalled since the March of 2022. We have had no increase in the number of people employed. Yes, payrolls have been growing like crazy, and that divergence is something that economists always have worried about, but this year it's bigger than ever. So how strong is the labor market? Because that's key to the kind of inflation, the wage price inflation that the Fed is trying to stomp on. And right now, as wages are 4 or 5%, that's where the Fed is worried that it might rise more.
Guys, stay right there if you don't mind. We just had a 5-year note go up for auction. It doesn't sound like it went that great. Let's bring in Rick Santelli. He's tracking the action over in Chicago. Rick, what can you tell us?
You know, I gave it a C, a straight C, very average. And as you look at an intraday of 5-year notes on the chart, you can see we haven't really moved up or down much. So that would be a good validation of that grade. The main reason for an average grade, 3.973 was the auction rate for 43 billion fives. The one issued market was trading around 3.96. All the other metrics were in line with 10 auction average. It just priced a bit on the sloppy side. Kelly, back to you.
All right, so let's talk about this for a moment. Bob, even as that went over not that great, we still have the Dow down 143. Down 300 was a little bit more scary, but the real tell today, Bob, seemed to be the way that Apple shares were trading. I mean, when it slides to a 52-week low yesterday, opens today, can't really get a bid, slides again to a new low, you can't be that surprised that the whole market just kind of turns lower. Although, as some were pointing out, maybe it was the rise in bond yields that was the real catalyst.
Well, look, Apple comparatively has held up better than other big cap tech names, and so is Microsoft. So Apple's down 25% for the year. When you see other big names down 40 or 50%, you know, that's a comparative holding up a lot better. So when people see Apple sliding a little bit more than the market or even more than tech stocks, they get a little worried saying, see, they're coming for the last names that are comparatively still standing at that point. I'm not sure I'm that concerned about that. What really worries me, and I take a little bit of difference of opinion with Bill on this, is what I see is the differences of opinion about next year. I've never seen such a wide divergence of opinion. I know people, Kelly, who have 3,600 for a 2023 price target on the S&P. I know people who have 4,700. I know people who have $60 oil. People have $120 oil. I know people who think earnings are going to be down 15%, and I know people who think that earnings are going to be up 10%. That is a really, really wide divergence of opinion, and to me, it signals how difficult it is to figure out what's going to happen next year, given we've still got the Russia invasion, we've still got what's going on with COVID, we've still got the Fed higher for longer, and that's making any prognostication really, really difficult.
Yeah, exactly. And to that point, here's Bill's prognostication, which is basically he thinks inflation will fall faster than expected, but the Fed won't really react to that, Bill. I mean, and so, yeah, it's all a little bit confused as people try to figure out, you know, which of these is going to be the most important factor.
And the key is to decide how you manage your risks. And one of the things that I'm absolutely convinced about is that the Fed is going to treat this inflation like a forest fire. They're going to make sure every ember is wiped out before they ease up on policy. They want to make sure that there are no resurgences in wage price spirals. And right now, Bob's absolutely right. There's a huge dispersion of views, but the skew of the market, where the market seems to be leaning, is toward this consensus trade. And so I think that's the uncertainty there is giving us a lot of noise and volatility. But ask anybody out there if they have a view of the economy that is different than the consensus view, and most people sort of are on that page.